Hello and welcome to another edition of the Zero to Educate podcast. Today we have with us Mr. Debashish Bose of Oaks Asset Management. Mr. Debashish has been with us previously for another podcast, and we'll leave a link in the description below. Now, in this podcast today, obviously it will be a continuation from the previous podcast, but at the same time, we'll be talking about how money is made in the modern world and how the current geopolitical events are affecting the current existing financial and economic system. While we're at it, we'll also talk about if there is a possibility that we're moving to a potential de-dollarization. And if that happens, what are the implications on the current world order? Now, within all of that, we'll also try to fit in what should be the concerns for India as a country and for each of us, that is, the average Indian investor sitting here. So please tune in. Hi, Debashish. Thank you for joining us and agreeing to do this. Looking forward to learning a lot of things from you, Swara, and a lot of developments have happened since your recent podcast with us. And once again, it's a pleasure talking to you. I hope at the end of this podcast, I get to learn a lot, and so do our listeners.
Sure.
Um, so, generally, I want to talk about. So, before we dive deeper into this podcast, I just want to dive into all this craziness that's been going around in the world. How do you see the bigger picture unfolding, and what do you see? What in terms of where we are in the world right now, and how are you personally making sense of this world that we are in?
$1 million question, of course. But let's try and deconstruct it a bit and keep it at the world level for now, and we'll sort of come into the
Sure.
India picture. I think a little later down the road. And before I go to what's really happening in the world, let's just talk about money, because I think that's at the center of everything.
Okay.
Uh, and and for that, let me just go into the concept of how money is created in the modern world.
Mm-hmm.
Because as we go down that thread, I think a lot of things will start making sense of what's going on. Money, as we see it, has three parts, out of which two we can see, but one which most people do not see.
Mm-hmm.
The first part is what the central bank prints money, which is essentially the sort of base money created by any central bank. Now, that's typically a smaller portion of the entire money, but gets a lot of publicity, of course, especially over the last decade as the central banks have been printing money and so on. So that's completely owned by the state, so to speak, and it is also so-called created within the particular country of whose money we are talking about or whose central bank we're talking about. So whether printed,
Mm-hmm.
dollars printed in the US by the Fed or rupees printed in India by the RBI. So that's one. Second is money which is created by the banking system, again within the country. Okay. Now, how banks create money is that, let's assume any of us go to the bank for a loan. Then let's assume they give you a 100 rupee loan. Simultaneously, they create a deposit account for you and put 100 rupees into that account. So out of thin air, literally, they have created an asset of 100 rupees, which is the loan to you, and a liability of 100
Mm-hmm.
rupees, which is the deposit lying in your account. Okay. But this money did not exist. It literally got programmed and created overnight, subject to the bank having enough reserves with the central bank as per the regulatory norms. So that's the second part of money, which you could say is a combination of public and private. Public in the sense that, yes, it is governed by the regulations of the RBI or whichever is the central bank in terms of how much reserves should be there and so on, how much capital adequacy should be there. But at the same time, it's created by a private entity, which is the bank. Okay. The third money, and that's the really big one, which we don't see, is the money which is created by a bank, or it could be another financial institution, and on the other side is another financial institution. And this happens via swaps or other kinds of financial derivative instruments. Globally, this is known as the euro-dollar market. It's essentially
Mm-hmm.
dollars outside the US, but it doesn't have to be. It could even be a euro JPY market or something else. It essentially means
Correct.
money which is created outside of the jurisdiction of that central bank. The central bank per se has no regulation also which is applicable on it. It could be something like a European bank could have issued dollars from its London office, and that money is going to an institution in China via another Japanese bank. Right? So that's how the financial system works. Now, this is pretty much the basis for issuance of all of this is the kind of faith you have in the counterparty. So, if I trust the other bank or the other institution or the hedge fund, I'll go ahead and issue it. So, because there is no regulation per se on it, and because it's really dependent on faith, theoretically, there's no limit to which you can issue it.
Hmm.
Okay, so this part is almost entirely private money. It's very, very global in its nature, and its scope and reach goes well beyond the boundaries of the sovereign. Okay, so let's just park that aside. This is the three, call it the three pillars of money, so to speak,
Hmm.
and they increase in size. The central bank is the smallest part. The banking system is as we know it, which is pretty much the assets of the banking system, and this no one truly knows how big it is. The estimate is it could be anywhere between 50 to 20 times the size of the GDP itself. Now, typically, banking system assets will be a little less than GDP.
Hmm.
In the worst case, if there's a whole lot of lending like what's going on in China, it could be 2-3x of the GDP. But in India, it's probably a little less than 1x of the GDP. So that's the relative scale of these things. Okay, this is money. Now let's look at it from another angle, which is geopolitics. Uh, Now, as I described, the the money which is there, because so much of it is created outside of the jurisdiction of a particular central bank. Therefore, it matters that what is it denominated in, which currency is it denominated in, and that makes for very interesting reading, because you could be having your economy or whatever denominated in your currency, but so much of things which are happening to you may not be denominated in your currency. And let's actually go into financial markets here and just look at relative sizes, and this thing starts becoming clearer. So let's say the global GDP is about 100 trillion. Okay. But that global GDP, about half of it may be emerging markets, half of it may be developed markets. Okay. So you could say each of them being denominated in their respective currencies. However, like let's look at global equity markets. It's again maybe a little more than, or let's say roughly about the same size as global GDP. But here, maybe about 70-80% is denominated in uh, developed market currencies. Even when we look at the real economy, while only about half of the GDP is, uh, let's say, from the Western countries or the developed markets, almost 80 to 85% of transactions happen in developed market currencies. Now let's look one level higher. Let's look at the bond market, which may be 3x or 4x the size of the real economy. Or let's look at this derivatives market, like I described, which is that private money piece, which could be several times the size. Now, this
Hmm.
may be almost 95% denominated in developed market currencies. So, essentially, if you look at this inverted view of the world and the control over the financial system, which is really so much bigger than the real economy, it's almost completely controlled by developed market currencies. Now, put yourself in the position of China, okay, who you could argue today is the true threat to, say, the hegemony of the US. But it truly isn't in a lot of ways, because the Chinese yuan is almost irrelevant as far as the global currency system is concerned, or control over the currency system itself or the financial system is concerned. Now, that is obviously what it obviously implies is that if the financial system is controlled by somebody else, you have no control really over your economy for all intents and purposes.
True.
So, in that construct, if you are the so-called emerging superpower who wants to topple the existing superpower, you have to figure out a way around this. And that is the crux of, let's say, the issue which we are facing, where I'm trying to marry the geopolitics and the
Hmm.
financial side, and why this is a much, much bigger, broader problem than what it may appear on the face of it. Now let's take this forward. That what's really sort of going on. So we've had this, since we had that last podcast, we've had obviously a whole lot of geopolitical issues starting to happen in the world. In that last podcast, I talked about something called financial repression. Financial repression refers to a strategy where you keep your interest rates intentionally below the rate of inflation. And you do that because what you are effectively doing, that let's say your bonds are at 2% and inflation is at 6%. So every time you issue a bond, you're essentially taking 4% away from the saver.
Correct.
And with that cheaper bond which you've managed to issue, you're able to, or not receive cheaper bond, but the cheaper price at which you're able to issue the bond, you're therefore able to keep buying back debt and all that. And why would you do that? Because your levels of debt are very high and you want to bring down that level of debt over time. There are two ways to do it. I mean, either you just cancel out all debt and you create a whole collapse of the system, which, politically is just not feasible. But the other option is that over time you keep chipping away at it. And this is the method to do it, which is financial repression. Okay. Now, the last time something like this was practiced was in the 1940s during the Second World War. So when we were looking at, at the time of the podcast, the conditions for financial repression were already there. It was already going on. Inflation was already running hotter than where bond yields were. What was missing was a geopolitical conflict, which is World War II. And maybe some version of World War III has already started. So the geopolitical angle has also come in. Right? Now let's look at this over here. Let's look at the geopolitical divide, and then again, some of these things start becoming clearer. We've got on one side the Eastern world, so to speak, which is maybe Russia and China, which is kind of acting in tandem, and whoever else may be on the periphery with them. And then you've got the Western side, of course, led by the US. You have the power which the Western sides have is what I already described, which is the power over the financial system. So what they can truly do is damage on the financial side, and the sort of tail wags the dog here because the financial side is so big. So that damages the economic side as well. From the eastern side, the power which they have is that somebody like Russia is a very systemically important player in the commodity market, whether it's the hard commodity or the soft commodity or oil.
Mm-hmm.
And someone like China is the biggest player in the finished goods market. So one side can weaponize the financial system, the other side can weaponize the real economic system, both the inputs as well as the finished goods. China, if you see, since the time, in fact, when we've had that podcast, which is back in, I think, Jan, Feb, or whenever that was, we've literally been on like a lockdown over there forever, which, is obviously exacerbating all those supply chain situations. So now let's, take a step back and look at this whole thing. You've got this situation where, yes, there's a financial war on one side, and there is a real economic war going on the other side. The real economic war, in some ways, almost ensures that supply chains will need to be reset, or that energy systems will probably need to be rethought. I mean, especially Europe is front and center to it right now. Right? If there was a push towards green energy, it probably needs to be accelerated. But the only problem is green can only be so, from an engineering point of view, it is only so efficient. I mean, it is a lot less efficient. So
Mm-hmm.
therefore, other things like nuclear and hydrogen and water and all of these things also have to be accelerated. Right? But all of these accelerations don't happen overnight. I mean, it takes a while to set all these things up. But it has to be done. So at the same time, if there was, COVID had already introduced the concept that you cannot depend on supply chains from all over the world and you need to sort of nearshore and onshore and all of those things. Now, if there was any doubt in that, that might have completely got removed by this geopolitical situation.
True.
So you've got a potential breaking of energy chains where high energy
Mm-hmm.
prices helps, because the higher the energy price, the higher incentive there is to create alternatives. a breaking of supply chains, where again the geopolitical reasons and all of that have come in. But more importantly, again, if there are bottlenecks constantly, it's almost imperative that you need to relook at it. But these two actions, if we look at it, are actually inflationary. Because if you are to create a new energy system, like I said, it doesn't just happen overnight. You have to build it over time. It's probably a 15, 20-year transition. It's not something which can just happen like that. Similarly, if you have to go ahead and do like e-mobility and things like that, again, it's all very well to say we want so many electric cars and all that, but where are the materials for it? Mining has not happened for a long time, and a lot of constraints have been there for mining companies because of ESG norms. So if that's not happened, for a mine to also get functional, you need about 4 or 5 years lead time. So you've got all these impediments, and even if you set up factories, it takes a while before production stabilizes, all of that, right? So these are all things which support the broader financial repression, which is inflation can run higher for a period of time. So everything which has happened in geopolitics is almost pointing in that same direction, or almost reinforcing the same direction with certainty.
Hmm.
So now if you now evaluate this world, it starts making sense that yes, there's a break of the two
True.
systems. There is a transition which is on. Now let's come to the specifics of what has been going on. And I think a lot of it got triggered by what started happening with the yen at the early part of this year. What we saw was the geopolitical conflict, which is Ukraine, Russia, all of that, Russia being the aggressor and so on. Japan sort of launched the currency conflict, so to speak. And let me explain that mechanism. Uh, Japan has been practicing something called yield curve control, which basically means that you will ensure that the bond yield at a particular maturity, let's say the 10-year bond yield, will not go above a particular yield or a particular rate, which in their case was a band of about 0 to 0.25%. Now, how do you do that? You do that by buying unlimited amounts of bonds. It differs from QE, where QE is usually saying that I'm going to buy X amount of bonds every month. Here you're saying I'm going to buy unlimited amount of bonds to ensure it stays at that level. The price stays at that level. They've been doing this for a while. Now, it didn't matter when everybody else was also doing quantitative easing. But it definitely started mattering once the Fed started its uh, practice of raising rates and potentially doing quantitative tightening down the road, which they've actually started this month. So when you then start seeing it, what you're doing, one big country in currency terms, is making sure its yields don't go up. And then there is another, the major reserve currency, where the yields are going up. So it's almost a no-brainer that you would borrow in yen and deploy it in dollars or any other currency for that matter. Because if every other central bank is also raising rates, you'd start doing it.
Hmm.
Yes, simultaneously, FX hedging costs spiral up because obviously everybody's getting in on the trade, so the banks will start charging much higher FX costs. So that may impact the ability of people to hedge it back into the yen. So if you are a Japanese institution like a pension fund, which typically was buying US treasury bonds, for instance. Now, normally what you would have done is that you would have, deployed your currency, bought dollars with it, bought those bonds, and hedged it back into into the yen. The cost of doing that was very, very low earlier, but with the FX hedging costs having spiraled up, the cost of doing that may not really be that feasible. So it's questionable, once this policy divergence started coming in and the rates started widening, the spread started widening, and uh, the FX cover rates would have started going up. Maybe a whole lot of standard Japanese pension plans and so on may not have been buying as much US bonds. So that would have exacerbated the rise in the bond yields in the US,
Hmm.
which was anyway going up because of all the other tightening and all those things. But a big buyer, if it starts stepping out of the market, And it could be other Asian buyers who are also stepping out of the market because your hedging costs were just too high. Because as a pension plan, you're a bureaucrat. You're not going to take currency risk. It is you're not running a hedge fund where you're getting paid to do all that. Right? So you're not going to do that. So that's exactly where things stand. That it's that spread between the two started widening. Now, if you're so then for the speculators, it becomes like an easy trade. Let me just short the yen, use the proceeds to buy dollars or buy anything, and do this trade. So how it manifests is with the yen starting to fall. And you've seen that over the past 6 months where it's probably fallen, 30% of the top or something of that sort. But the yen falling has deep implications on the economic system because Japan is a big exporter nation. Who does it compete with? Directly with Germany, almost like for like in terms of the industries they operate in. So if the yen is weakening, can the euro stay very strong? Not sustainably. It has to weaken to be, counterbalancing on the export side. Similarly, within Asia, the developed side of Asia, which is Eastern Asia, also competes with Japan. So whether it's China, it's Korea, it's Taiwan, all of them across, as a
Hmm.
combination compete in the same industries. So again, they have to start weakening. Right? So the won has been weakening, the Taiwanese dollar has been weakening, and the yen also has been, the Chinese yuan also has been slowly weakening. So this then brings to what is the geopolitical angle to all this, which is if now you look at it from the perspective of the Chinese, on one side your competitor exporters have just become 30% cheaper, right? Or let's say over the last 5 6 months, which is huge
Hmm.
in terms of export markets. Secondly, you yourself have been having a tightening situation for the last 2 3 years because of a real estate crackdown and maybe an edutech crackdown and whatnot, right? Now, how much of it is politically motivated, whatever it is, maybe we'll never know. It probably doesn't matter. The simple answer is if you have such big, especially the real estate market falling apart, there is definitely going to be defaults and there are definitely going to be like banks become tighter with money, as simple as that. So you're facing a tightening situation exactly when your exporters are also losing money and they need some liquidity. Right then, the Fed is also increasing rates. Now, the Chinese yuan is loosely pegged to the dollar, which means whatever monetary policy is followed in the US gets transmitted to China because you're essentially a pegged currency. Right? So if that currency is hardening, that your currency will need to harden to sort of stay in balance in terms of the peg. But your exporters are going the other way. Your competitor exporters are going the other way. So that's a big conundrum you're facing right now. So what do they do then? They could either let the Chinese yuan fall, but they don't completely want to do that for a few reasons. One, keep in mind our origin story, which is that we're talking about money and China wanting to be a bigger player in the money market. The last thing it'll want is its yuan completely getting decimated. The whole faith of the Chinese yuan falls apart. That's one. Secondly, in the last 5 6 years, a lot of money has gone into the Chinese bond markets from offshore, and that provides liquidity into the system. I mean, they got included in the MSCI, whatever EM indices, and so on, and it's a big part of the indices. So once that happens, once your currency starts depreciating, your bond markets essentially start suffering, right? So you can't completely, let that happen. But you've got this tightening also being forced on you. So now if you see the walls are so, so to speak, getting closed in on China. And that explains where the currency conflict angle or the currency war comes in.
Hmm.
Now, how does it resolve itself? We'll have to see. But there's a decent chance that if this whole thing continues at some point or the other, they'll need to break the peg. It may not necessarily start with the yuan itself. It may be a situation where the Hong Kong dollar, which is actually pegged to the US dollar at the moment, but it's been sitting at the high end of the peg, that is broken first, and it needs to be, say, repegged to the yuan. The Hong Kong dollar getting repegged to the yuan, which then effectively makes it almost exactly a liability of China, and therefore expands the pressure on the yuan over a period of time. So that may be the broader angle going on, and the objective for someone like a US to try and do this, because whatever Japan does, all said and done, it's broadly under the control of the US, so to speak, post the World War II kind of developments which happened, and therefore when you look at this angle, it's essentially trying to weaken China by cutting off its source of money. Also, keeping in mind that in the last several years, a lot of their surplus cash which they were generating from their exports have actually been redeployed into multiple countries, including in our neighborhood. And a lot of that has blown up as well.
Hmm.
So they are cash strapped. There is an internal weakening going on. And then you have this exporter sort of war which is put on them. And then you have this tightening conditions also which are put on them. So that's the bigger game which is going on. So everything which is happening around it is a bit of collateral damage. But that
Hmm.
collateral damage is another important part to keep in mind. Uh, I described this whole financial system, right? And the private money system with these derivatives. All of them use the safest government bonds as collateral because it's all levered. So the bonds issued, whether by the US, Germany, or Japan, and all of these are the collateral. Of course, there's not been a whole lot of German or Japanese issuance available because their own central banks have been buying all of it. So some of that has got, bought by. You may have used Italian bonds, you may have used other things, to do all
Hmm.
this. Now, as yields start going up, the value of collateral drops. And as the value of collateral drops, you're then asked to post more margin. Now, where are you going to get margin beyond a point? You have to look to sell. So that creates its own sort of turmoil in the system. So it's almost like a bit of a battle of who's the last person standing. Right? So now, if you just link all this together, how money is created, how the financial system works, the geopolitics in play, and the sort of wars which are happening at the military level on one side, which is what we see, and the financial and all of that at the other side, it sort of starts making sense what's really going on. So sorry for the slightly detailed answer which I gave, but I hope that made sense.
No, no, that answer was really on point, and it actually covered a lot of questions that I intended to ask you.
Sure.
And coming back to what you talked about, what you said about Fed's policy really affecting what's going to happen in the entire world, there is this question that I wanted to ask, right? So, right after, let's say, the World War, there was this idea of sovereign nations and the idea of nation state, right? But over the years, we've seen that because of this massive globalization that we've seen, there is this idea that there is effectively a single, let's say, monetary policy for the world. That is effectively that the Fed dictates that monetary policy, right? So, in terms of that, let's say, as an Indian, I would be concerned about how the RBI would, let's say, tackle inflation, right? Obviously, the problem is not as exacerbated in India as it's in the US right now, but we could potentially have that sort of a situation. And what sort of, let's say, leverage or what, not leverage, what sort of say or what sort of powers do central banks have in this current scenario, especially in light of the fact that we are seeing that there's a breakage in the global post World War II order, right? And there is, let's say, there is a block of countries that have the money, and then there is now a block of countries that have the resources. So there is also growing, let's say, concerns and growing feelings of resource nationalism that's been creeping up. So in that light, will there be a new commodity super cycle? And if that happens, will central banks have enough say and, let's say, enough ability to influence what is happening in the world? Will they be able to tackle inflation effectively? So it's a general question that I'm asking
Yeah,
because
that's a lot
I
to
really
do with
appreciate how you,
it. Yeah,
yeah, yeah. Correct. So
sure.
yeah.
Okay, let me take a stab at it, and I may not necessarily go in the same order that you asked, but let me just try.
Hmm.
So, firstly, are we broadly under a similar monetary policy and all of that? Yeah, I mean, for sure we are, and that is for the reason I described, which is the
Hmm.
what is money, and how money is
Correct.
created. The three parts: the public side, the public-private side, and the private side. Now, are they necessarily that much in control? That's not necessarily true. And the reason is that when I look at that third side, which is the private side, and that's the globalized money, the globalized financial system, so to speak, and a lot of which the common guy just doesn't see it. Uh, Now, that sort of lies outside the jurisdiction of central banks.
Hmm.
For if you look at the balance sheets of most of these large banks, this is usually not on the main balance sheet; it's off balance sheet items. I mean, it
True.
is a bit ridiculous because your main balance sheet could be whatever $100 billion or something, and your off balance sheet could be $1 trillion. Literally, that's the order of magnitude or higher. In fact,
Hmm.
I remember this when Deutsche Bank had its troubles some time back. Their main balance sheet was about $45 billion, but the notional value of their derivatives was about $45 trillion. Now, no one counts it as notional value because what they do is they have offsetting trades. So they say that post all those offsets, maybe the actual value is only 5 trillion. I'm just throwing up a number, but something like that. All of that is well and good when the markets are normal. But keep in mind, all these markets operate on faith. And if faith is not there, if you're not trusting the other guy, or if one party defaults, then one offset goes out of the window. And if one offset goes out of the window and you start losing faith, everybody, faith breaks in the whole chain. So suddenly your, so-called net exposure has gone back to becoming a gross exposure, right? So whatever you netted off and brought it down to 5 trillion has suddenly gone back to becoming a 45 trillion exposure. So that's how rapidly this whole system shifts. Now, all of this is outside the control of central banks. But what happens is it's like, it's the naughty kid who goes and does something wrong and then comes home crying to his parents. That's exactly what happens. That technically you're bankrupt when these things happen. So then you push the policy wires and make sure things work in your favor. And depending on where you stand in the hierarchy of importance, you either survive or you don't. Right. So that's the system. Uh, so therefore, the central banks don't necessarily have that much control, but they obviously have to play a role to sort of save the system from time to time. So they get a lot of bad rap for a set of things, but honestly, a lot of times, what alternative do they even have? So that's one part. Uh, Now, of course, going back to how I described, because so much of transactions happen in developed market countries, it therefore means the policies followed for money in those countries
Hmm.
have an inordinate influence around the world. Now, some parts of that are starting to break, but it's a very long process, and this is the process by which currency systems change. It's happened in history before. You've had multiple, periods where there have been different dominant currencies, starting from whenever the Roman currency and so on. That history is there for everyone to see. And maybe we are seeing the start of the end of the dollar dominated system.
True.
But usually before it ends, probably it'll have one big flare up and destroy everything else before it ends. But let's just, not jump the gun here and just sort of look at the mechanism of it. Okay. Uh, just when this war got announced and it got started, and then you had these sanctions which came in. So there was, of course, sanctions on Russian entities being allowed to operate in the global system. There were restrictions on the SWIFT transactions which they could do. But a much more severe thing was put in place where the assets of the Bank of Russia were confiscated, which is an
True.
unprecedented move. Central bank assets never get confiscated. It's like
That's the first time this happened.
cozy club, and that got broken. Now, once you've crossed the Rubicon, so to speak, uh, every other central bank who has FX reserves will have to be, its risk management department has to be thinking on the same lines that can I really afford to keep 40-50% in dollars? Right. I'm sure the RBI probably is debating the same thing, although there's no immediate need for us to
Hmm.
change anything. But it is a debate which will happen. Now, once the debate starts, then you start thinking, okay, what do I really need those reserves for? And let's just look at our case, right? What do we need it for? We need it for oil or for the things we import from China or the things we import from other commodity places and so on. So, should we keep it in US bonds or should we maybe buy some oil assets? Should we keep something in yuan and won and whatever other currency we buy stuff from? And maybe keep, instead of 40% in dollars, maybe keep 20% in dollars. That may be a manageable risk if even if something goes wrong tomorrow. So that's, and the follow up to that is where you've had these conversations where, let's say, you want to transact directly with Russia in rubles and rupees, settle those trades and buy their oil and whatever else you are buying and selling, and similarly in other currencies. So all of this earlier was all going through dollars, right? Even if I was buying oil from the Middle East or something from Russia and so on, or something from China, it was all settled in dollars. And you're saying, what's the need for it? So that line has been crossed. Does it mean that wholesale we move to a new system? No. Yeah, but it's going there, right? So once it starts going there, the use of dollars starts coming down, and that becomes the basis for the change. Now, when does this change get accelerated? It's the same concept as what I was describing as the need for energy transition. Higher prices ensure transition, not a
True.
lower price. Right? A high petrol price will ensure
Correct.
you go and buy electric vehicle. Same logic here.
Correct.
The higher the dollar goes, which means the bigger the shortage of dollars you have, the bigger is the incentive to explore other mechanisms. But is there a method, or is there a particular currency which can just replace the dollar? There is none. So what we may then move towards is maybe a bigger basket of things, which is, yes, we've got a certain amount of dollars, and maybe the big part is still that, but the other basket also has other currencies which we buy things for. And at the same time, we have other assets which we need to own. So depending on the context, whether it is oil for us or some minerals for some other country and so on and so forth, we could have that. And yes, we are probably moving into a digital world. So maybe there are going to be digital assets also, which are part of this whole thing. Now, whether that's the rabbit hole of crypto or it's some other things or whatever it ends up being, I think that's still in a very premature stage today. But you would, in the current context, say that yes, it could be a basket of currencies, certain essential commodities and things, and maybe certain digital assets, and maybe something else which we don't know today. Right?
Yeah.
So, should that transition happen, and maybe gold and all those things could come in there. So, should that transition happen, then the demand for commodities and all of that is something we haven't even factored in by a long shot
True.
at the moment, and that's one of the probabilities you have to keep in place. There's another important function in all of this system, which is a concept called the swap lines from the Fed. Now, how that works is that when all of this some chaos has happened and you come home crying to your parents that save me type of thing, that's when the Fed goes and tries and prints money and does something about it. The other countries are, of course, suffering at that point because maybe they've bought a whole lot of dollars in some form or borrowed a whole lot of dollars in some form or the other. Maybe their corporates have raised money in dollars, whatever the way might have been. But they are, facing a scarcity of these dollars. So, how do they get it? The Fed could, at that point, say, "Okay, you are my friend. Let me open a swap line with you." So again, let's look at the hierarchy of the world in that context. You've got the US, of course, on top, but then you've got these major currency or countries, which is the European Union, the Japan, and England or the UK, where they already have open swap lines with the Fed, and they can access that, and that effectively means that they are, parties to the Fed coming and bailing them out when they truly need it, and which is why the power of their currencies sort of also comes from there. Then you've got, maybe a set of other countries where, they may be friends or, the likes of Mexico and all of that, where, they're nearby, Australia, all of those kind of nations where, if required, the swap lines get open. Now, there's a possibility India comes into that. It isn't currently, but it could come into that line of it. Or if India's importance truly goes up in terms of its geostrategic importance, then it may even come into the higher strata where Japan, European Union, and UK sit today. But again, that's speculation. We don't know it'll happen. It won't happen. But for it to happen, first the bond markets have to be opened up, and that's the path towards getting there. And then you've got, say, the enemies of the state, so to speak, which is the Chinas, the Russias, and so on and so forth, who've not, who will not necessarily get access to this. I mean, China's of course been a big beneficiary of this whole dollar system. That's really what has grown it also to a large extent.
Uh,
So,
yeah. So Debashish, if I may interject. So you talk about this idea of the enemies of the state, right? And let's say, in my understanding of the world, like however limited it may be, the way that I see is that there is, let's say, there was a happy marriage between, let's say, China and the US, right? Where China provided cheap goods, US could, let's say, keep its inflation rates low, and that sort of worked. Then similarly, Russia provided cheap gas to Germany. Germany could produce a lot of goods based on that cheap gas, and then both of the, let's say the money that was flowing out of the US to China, or let's say the money that was flowing out of Germany to Russia, was then very gladly reinvested by them in G7 countries, right? So because there was an inherent trust between these countries, irrespective of how uncomfortable they might have been with each other, but there was an inherent level of trust. But I think that level of trust is now breaking, and that's what you said in the beginning, right? That there is an inherent trust within the financial system that keeps driving these things. Now let's say when this sort of trust is broken, does it now create fault lines in this world order? And so I was just coming in with this, and now within this context, if you could explain to our listeners that now there's, let's say, like a disgruntled spouse Russia and a disgruntled spouse China, and they have now found, let's say, a common ground between them, right? Because China is literally the factory, and Russia has all the resources that China needs. And because of this geostrategic positioning that's been happening, and there's a possibility, as you said, that we are in some stage of the World War III, and chips are a big deal. Chips are really important for that, right? Because US might have a lot of missiles, let's say, to enforce that world order, but the US needs chips from either Taiwan or China to run these missiles, to aim these missiles, right? Now, this also brings me, sorry for this long question, it also then ties in with this idea of resource nationalism that I was talking about in the beginning itself. Now when you club all of these together and you see that there is an implicit breakdown of faith. Now, with so how do you see things progressing in this direction? How do you see the impact of this on the current world order? That, and another question that I want to follow up with this, we've always heard terms like too big to fail, right? So for a very long while, banks used to be too big to fail, and now we're sort of, let's say, grappling with this idea that globalization is too big to fail. But what if it does, right? Because the implicit trust within system has broken. As you rightly said, it's the first time that a central bank's assets have been frozen. So that's literally the breakdown of trust at the very highest level. So do you think that deglobalization is going to happen? Do you think, let's say, de-dollarization, not today, maybe 10, 15, 20, 30 years down the line, as you said, it's going to take its own time. Do you think all of that is possible in the world today?
uh, short answer, yes, everything is
Hmm.
possible. Uh, but before we sort of get into each of these things, what I'd like to sort of point out is it's very important to think probabilistically now and not deterministically,
Correct.
and just condition the mind to doing that. Right? I mean, let's just take any of those examples, right? Like US dollar breaking down. Probability of that happening? Yes. Why the probability of that happening is there? Because what are the key things on which the US dollar system was based? If you look at the post Bretton Woods era, it was
Hmm.
paying for oil, the petrodollar system. It was paying for goods, which is where China ultimately came in as the cheap producer. But preceding that was the other, East Asian miracle economies and all of that. And also for the financial system which got created using all this private money which I was describing, all of which is where you were using dollars for the capital markets, for resources, paying for resources, pricing resources, and paying and pricing finished goods. Now, if you get into a scenario where I am saying that, okay, my supply chains are not trustable anymore because China may simply decide not to give the things to us, or Russia may decide not to give us those commodities, I have to think differently and create different supply chains. Now, which means I have to create different factories and all that. Now, as a politician, you've got to love that because it means you get to announce setting up of a factory and win a voter base which has gone disenfranchised against you for a long time, right?
Like
So
the Chips Act, for example, it just
the
got
chips
passed.
are, there you go. Now, so but what it also does is longer term, it says that, okay, do I necessarily need then those dollars and the basis for which all the system was created if that system itself is about to fall apart, right? So
True.
the probability of all of those interlinked things exist, which is if more and more we start buying oil directly from someone else and things directly from someone else, and more importantly, start producing a lot of those things ourselves, and every other country basically goes and replicates the same model, then yes, of course, we deglobalize in every way, which is we deglobalize in the economic sense, we deglobalize in the financial sense. From a financial sense, that has wider implications. What becomes the cost of capital then,
Correct.
right? Or are we truly able to harness, let's say, the capital within our country and keep the rates low? Or if we are not, if we've always been dependent on foreign flows and all of that, then if suddenly they stop coming in, then what becomes the cost of capital? Right? So all of those questions I think we'll have to grapple with. And therefore, all of these are probabilities. There could even be the other probability that China gets completely destroyed over the next 1 or 2 years, and the same thing happens to Russia, and we are back to the same old world. Maybe a lower probability, in my opinion, but a probability nonetheless. So
Nevertheless.
think of it in each of those angles, because obviously we're coming from the construct of how do we invest around these whole things. But yeah, you're absolutely right. All of these things breaking is essentially a break of the way the world has worked in the last 40, 50 years. Uh, to the extent you have been part and beneficiary of this broader financial economic system, the the shift or the change for you is that much more dramatic and that many more things to deal with. In some ways, India is a bit lucky because just like we missed the whole, telecom thing and therefore were able to leapfrog straight to mobile phones. Similarly, we may have missed the entire economic cycle because we were truly not part of the global, that whole supply chain system except one or two industries here or there.
Mhm.
And we may move into the a system where it actually is much more about localized chains. And there, having a big country is effectively like a world of its own, right?
Yeah.
So those are, I think again a whole bunch of probabilistic paths which open up, and one has to constantly wait and sort of keep assessing, how to go about it. But yeah, all the points you raised are you're pretty much on the right track.
And this term has cropped up many times post Bretton Woods era, right? Now, so I've been reading a little. There was Mr. Zoltan who works at Credit Suisse and keeps writing. So he's been toying with this idea of Bretton Woods 3, right? And you also, let's say, in the middle also said that if there is, let's say, de-dollarization, if people lose, let's say, faith in the dollar, if people realize that we might be able to work without the dollar, do you think that there is a possibility that there would be a Bretton Woods 3 system? And what, I mean, for our readers, for our listeners, like, can you elaborate a little? Could you speculate a little, right? Because this is all speculative at this point of time. Could you speculate how that world would shape up? And like, will that be the end of the global financial system as we see, right? Because I think you did a podcast with Right Vision where you talked about this idea of the global financial system being a misnomer, and it's it being very myopic in the sense that you're either with the US dollar or against the US dollar, and we need to, going forward, we need to recognize that regional alliances, military alliances, localized supply chains, etc. are going to be important, as you just said. So I want to just toy with this idea of Bretton Woods 3 and hear what you have to say about that.
No, absolutely, and I think Bretton Woods three is a direct outcome, as how Zoltan describes it, is almost a direct outcome of moving to a multipolar world,
Hmm.
right? Because that sort of precedes it. I mean, if we are in a multipolar world, is exactly why I would have a multipolar wallet, so to speak, right? Where
Correct.
only one
Yeah.
part of my wallet is dollars, and the other parts of my wallets are whatever they are, you know, other currencies, other commodities, bartering, whatever I'm able to, whatever I need. Also, what it means is that there are no permanent friends and there are no permanent enemies. It's pretty much everyone for themselves.
Hmm.
Now, is that necessarily a good thing? Probably not, right? I mean, history's pretty much shown that when humanity sort of comes together is when, things do truly get better. And I think the last 30, 40 years were probably one of the biggest in terms of development of humanity, so to speak. And possibly when we go into this other era, it may not completely be like that. That's one probability. But the other side could also be that, yes, all said and done, we are in an interconnected world, at least digitally. And maybe it truly doesn't quite work like that. And things could kind of be different. And I'll just throw a random thing at you. But we talked about all these decentralized, local supply chains and all of that. But
Hmm.
hypothetically, if 3D printing becomes the way to build things, and 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 we truly, and I'm going a little far out here because we, obviously we are speculating.
Yeah,
Uh,
why not? Why not?
you know, so let's say the future, and this future could be 20 years away for all you know, is that okay? Lots of stuff you can 3D print your way out, right? And you can just get it, and so your printer could be at home or some centralized Amazon warehouse or wherever else it is. You could also go a little far out in the concept of quantum technologies. What is quantum technology? It's mass to energy, energy to mass, right? So theoretically, I could email you the energy which is required to create a product, a physical product, whether it is food or some the chair behind you, whatever it is. And then you're able to 3D print it out through an energy transfer into mass, right? So we're integrating like the 3D printing with the quantum technologies over here, which possibly a quantum computer can do down the road. When we think of it from that angle, maybe we re-globalize at that point, right? Because we've sort of taken away the physical transfer elements by using energy instead, which is essentially what the internet always did, right? I mean, you broke down the need to write a letter and mail it,
True.
courier it across by simply being able to, or just for me taking a flight and coming and meeting you in Bangalore, we just broke it down and have this thing going. So, what is to say, matter as we know it today cannot also go down that route. So, that possibility exists. Is that possibility going to happen tomorrow? Definitely not. Uh, but so, is the current system breaking? I think yes. That I think one can say with a reasonable degree of certainty that if COVID was already pushing things in that direction, and this war is probably ensured it's going there. And I'm going back to the crux of what is behind this war, which is the money system.
Correct.
And the money system is so all pervasive and large that it has to break in some way or the other for this conflict to resolve itself. Because, militarily, there never are really any winners once everyone has nukes. Right? I mean, hopefully, we never use it. That's another Rubicon, right? But if both know they are armed at the same time, and if both know the path why we, the reason why we have this conflict is this current system, the money system, which in turn is based on the current way the economy runs, and so on, then a break of it becomes that much more certain. And I think that's what we have to just live with for now till things evolve from there. Does it end up down the road breaking the concept of nation states, which is that whole Westphalian nation of states, concept of
True.
nation states? Does it end up breaking all that and creating Balaji's network states or something of that sort? Who knows, right? I mean, all of that is way out in the future because all of those things, all said and done, again, bringing it back to reality and bringing it back to financial markets, which is probably our core interest over here, it's somewhat guided by the system we operate in.
Hmm.
Right? So, if the system we operate in is with nation states and capital structures in a particular way, we then end up deploying our capital accordingly, which is okay, this is my country and I will deploy maybe 80% there and 20% outside. And the capital structure suggests I should deploy it in some things in fixed income, some things in equity or equivalent instruments, and make some money out of that whole thing. Now, if all of these systems sort of break down and we get newer systems, then of course by default, some of these things start changing, and that's the transition. Now, transition periods are never pretty, right? Because and that's just what I'm trying to highlight here. No one truly knows, and that's what we just have to navigate via probabilistic path.
So the thing is, like I do understand that transitions are ugly, right? So let's say, as we talked about, how in earlier, let's say in 2008, at the time of the great financial crisis, India was relatively isolated, and we didn't really have to face the brunt of what was going on globally. Where do you think India stands today vis-a-vis, let's say, its involvement with the global happenings, and what are the implications of all of these events on India particularly? Right. So we've talked about what's happening globally. We talked about the financial system. We've talked about how money moves. Now, I would want you to bring all of this to India, because then it's a little more relatable to us as an everyday investor who's sitting here. Um, so yeah, so what are your views on how is it going to affect India, and how is it going to affect people like us? I understand that a part of your job is to, let's say, help out mature market investors and HNIs. But if you had to make a strategy for, let's say, buy and hold investors, beginner noob investors like me, what would your suggestions be in terms of how what's happening in India and how we should be going forward?
No, I think so. To the first point, I don't think we were particularly dealing in the financial crisis either.
Mm-hmm.
We fell with a bit of a lag, and which may have its own mechanisms sort of behind it. But we definitely did fall. We did a pretty good catch up, and we've actually not had a great time after that, because our currency, which was at 39 and at its peak, is 82 today.
Hmm.
So, irrespective of anything else, you still lost money. Even if so, a lot of the gains which we might have seen in markets from that peak of 2008 uh, is actually goes away when you put in place the fall in the currency itself. That was
That's a very interesting point.
yeah.
Yes.
All right, but let's park that aside and let's come to today. Uh, and I think if I didn't know anything, a few things stand out. Firstly, where India is today is very similar to China in the 90s, Korea in the 70s, US in the 40s or
In the
50s.
50s.
Right? We're in that cusp of where we are not a super poor country anymore, but we're still a low income country. But we're starting to make that transition to play at a much bigger stage. We may think of ourselves
So
already
we're
a very big.
Mhm.
Going.
Yes. Yeah, so we're all of these countries with Wi-Fi, effectively. Like our position right now is like internet, right?
Correct, correct. No. And that is important. So, but yeah. So, but let's just leave the Wi-Fi out for a bit.
Mhm.
We are in a very similar state like what they are. In a globalized world, we might have played the same game as all the other East Asian countries before us and tried to become a big export hub and all of that. But if the world deglobalizes, what exactly are we going to become a big export hub of?
True.
I mean, no one's exporting anymore, so or importing.
Mhm.
Again, it may or may not happen. Like I said, probabilistic view. But yes, if we are to make a transition from globalized to deglobalized, chances are exports are not necessarily going to be the big driver. Right? So let's. But even if I were to leave that aside, I think we're still at that phase where the even what we have within us is good enough to start propelling us in that direction of making a transition from low income to middle income. That's a very unique phase in history when a country goes through that, and you sort of start defying the norms of everywhere else when that starts happening, because you sort of have this own little engine. You're coming off such a low base that it truly doesn't matter too much, and so on. That's one part. Now, secondly, large parts of our country are actually sitting outside this whole global system anyway. Like we may be sitting and doing this conversation between us, it probably matters to all of 1% of the country.
Agreed.
Issues of dealing with inflation or scarcities and all of that is an issue with, I think, 99% have grappled with for a long time, and they're used to it. So to that extent, that resiliency and all of that which are already there make it in a slightly better place. Also, when I think of it in that money terms, the three parts of money, only part one
Mhm.
and part two exist in India, which is
True.
RBI money and banking system money. The euro dollar sort of money, which is that whole derivatives based money, from an Indian institution's point of view, doesn't exist because RBI doesn't permit it.
Mhm.
And that is remarkably sharp of a central bank to not allow this, which means, unlike the rest, they've not allowed their banks to go out of control and pose a situation where the bank's GDP is far, the bank's balance sheet is far in excess of the
It's
GDP.
greater than the GDP.
So that's not a problem with us, which is huge in this environment. Okay, so that's the good sort of base we are coming out of. We're moving in a particular direction. Now comes this war. What does the war do? It further reinforces that we have a bunch of import dependencies. Okay, starting of course with oil, but
Oil. Yeah.
defense, finished goods, several raw materials. There probably are other things also which I can't completely rattle off, but we kind of see it. I mean, we kind of know it, and that's a big reason why the currency is also depreciated the way it has. Right. So that's where all these the policies of the government also recognize this concept, which is why this big push of Make in India in various versions and the incentives which go behind it, and possibly even trying to make us into a bigger agricultural nation in terms of not just doing it for ourselves but at a broader level, and so on and so forth. Right. So all of these play a part in this. Next comes the financial part of it, and that's where again probability, and then that's where the Wi-Fi angle also comes in. Probability could be that yes, we stay while it may become a multipolar world because of our geostrategic importance. We do end up getting some sort of most favored nation status on a capital basis. Maybe we come into the different bond indices and the swap lines of the Fed and all that, which means our capital costs don't change too much. And also, where if half the emerging markets have already gone off somewhere else, so by default, people start figuring, okay, we need to find some growth somewhere, and we become one of those
Hmm.
areas of growth. And and if it becomes anything like what happened in China, maybe the capital cost even comes down, which is a great scenario for us. That is a probability. I mean, if all this broha is happening between the US and India, then that's a big part of it all. There is also the other probability that yes, the deglobalization also includes capital deglobalization, which means there are restrictions coming in every country. Keep in mind, like we've had this recent uh, chatter about the Bank of England's intervention because its pension plans were blowing up and all that, who were doing all this thing called liability driven investing, all that stuff. But not going into the financial gobbledygook. Basic story was that you have to go bail out your pension plans.
Yeah.
Right? And once you start doing that, then essentially the pension plans are also told that now you can't go do all this fancy stuff, just go buy our bonds. Right? And therefore also support our local economy and buy our stocks. And hence do not invest too much in other parts of the world. Now that's got nothing specifically against India. It's much more localized, but it's part of that same chain.
True.
And it's driven by political pressures than anything else. So that could happen. So in which case, our capital costs in the current context, for sure, if such a thing happens, our capital costs will go up to what we were in the pre-90s sort of era, which is the 13, 14, 15% capital costs, which obviously will affect everything, right? But that's where Wi-Fi will play a big part. What I mean by Wi-Fi is really what we're building with this India stack. And if you look through it, it's a continuum. What started with Aadhaar, which is going to UPI, which is now going to ONDC, which is going to account aggregator. All of this will
Hmm.
broadly enable flow-based lending as opposed to asset-based lending, which can speed up growth.
Correct.
Okay, and then you are talking about Badal for the distributed ledger system, which is essentially to build online trust, which means online transactions can have the same level of faith in the system like what stock market transactions have today. Right? You and I can anonymously trade on the stock exchange because we have faith in the counterparty and the whole this thing. But online, we may not have that kind of faith for any other commercial transaction. So having that, and the follow up to that is having smart contracts and all that, which in another way is like thinking just like futures and options today, which is basically a smart contract. Right. So having that in all kinds of online transactions truly opens up the network of our own country. And once that happens, you know how Indians love fixed income. P2P will truly take off. And when P2P truly
True.
takes off, we start uncovering, unlocking sort of the capital in our country. which have earlier otherwise just been in concentrated little localized pockets, and we open it up all over, and things start becoming much better. I mean, version one was probably, a lot of Indian people also going and backing these startups. And I think version two, or call it version three, whatever it might be, is what I'm really talking of, where you truly democratize this all over. And of course, the capital markets will adapt and all those things will happen. So that could be quite exciting if it happens. And that the combination of these could actually end up helping us make this transition from a low income to a middle income country much faster than what happened in other countries. Right. So that's how I would look at it. Okay. Now, what are particular areas you can participate by doing that? I mean, honestly, there could be any number of areas. But the way I look at it is that, okay, in the markets, which are the areas which have been relatively ignored, but which I think will be a big part of this transition? I think three, four parts of it are the physical areas itself, right? I mean, you do need a manufacturing ecosystem, you do need a bigger agri ecosystem, you do need a lot of supporting infra, logistics, and all of that to enable all this. You do need some big companies playing the role of the heavyweights who can do the heavy lifting and doing the capex ahead of the actual uh, demand and all that coming in. And then the other side, you've got the whole digitized ecosystem, digitized society, the all of those developing on India stack, all of that coming into play. And I think when these things come kind of marry together, you'll get levels of growth. How do you participate in that? I sort of named the particular areas I would look at, and I look at these
Yeah.
because these are relatively, I would say, smaller parts of the index today. They're not necessarily small
Mhm.
companies, but smaller parts of the index, and there are ways to play it. Then within each, there are of course going to be nuances of how you play it. Now, you can break your head over it, or you can take the simple path. I'm sure the industry will create enough ETFs and various other funds to play all this. So I think you just look to participate in all that, and try and capture it. At the same time, you'll have to be aware with Wi-Fi also means chances of disruption become faster, and therefore there could be areas where which are a little overblown today, and where the incentive to disrupt is very high. Like the bigger a part of it in the index, the higher the chance are that you would want to disrupt it. So you've got to think of it in that angle. And yes, if it's a world which is transitioning where the core systems of how we operate are all breaking down, then it is inevitable that volatility will be a lot higher.
Mhm.
Now, it is interesting that this period where volatility may suddenly go to levels we've never seen before because of a complete breakdown of how we're looking at these things is preceded by a period where there's been unprecedented growth in option selling, which is effectively short fall.
True.
So that's going to be a trickier, I think, one to play with in this era. So, so you'll have to look at where the opportunities are, and you'll have to also keep a strong view of risk management and kind of think of it a bit like poker. You know, what does everybody know? What is in their hands already, and what is not? What are they missing? And play your way around it. Not easy, but not impossible either. And that's how we
Not
need to
impossible.
go about
Correct.
it. Yeah. I guess we're out of time now, right? So
Uh, so just one last question, and then I will let you go, so to speak. So the thing is that we've talked about how there is a lot of money being printed generally. There is a lot of speculation. There could be, let's say, a lot of volatility. And this is a question that my mother would really want to ask you. What's happening with gold? Like, why is it not moving that much? And is it still? I mean, the conventional wisdom always says that it makes sense to have an allocation towards gold, and so I'd just like to hear your 2 cents on this.
sure. Now, gold in normal situations works inversely with real yields. So if real yields are positive, gold does not do well. Whereas real yields go negative, gold does well. Now the situation we've had is where inflation sort of ran ahead. You've had bond yields also going up, and then inflation sort of coming off a little bit, which means nominal bond yield minus inflation is real yield.
Hmm.
So as inflation has been coming off, real yield, which was negative, has started going positive again, and it's in fact quite positive in a lot of countries. So because of that, gold doesn't really do much in this environment. I don't think it's at the same
Okay.
time hugely overowned either. So therefore, it's not exactly collapsing completely. Uh, it's difficult to say what price is good or bad, but I think if you were to put a tracker of real yield, it will give you a sense. And I think when this whole thing starts reversing again, is probably where gold could run again. And that's, I'm talking in a normal scenario. That's how it trades.
Hmm.
Of course, if we go to a scenario where we are truly questioning uh, whether the dollar system will continue or not, that's where gold starts becoming important. At the same time, remember today gold is priced in dollars. So the higher the dollar goes, the weaker gold becomes in dollar terms. Okay. Now, the stronger the dollar goes, the bigger the chance that you break the current dollar system, not a weaker dollar. A weaker dollar doesn't ensure that you're going to break it, but the stronger a dollar goes, the bigger the chance. So, long story short, as the dollar keeps strengthening and bigger countries start buckling under, you probably have to slowly start adding to gold if you don't have it already, uh, with the understanding that you may not make any money for some time.
Hmm.
But should that system break, and that's the break points we're talking about, that's when gold becomes a completely different asset, because then it starts becoming a store of value.
Okay.
Because when you don't know what your new currency reserve is going to be or whatever basket it
True.
is going to be, it becomes a transition currency. And maybe it's part of the final basket, maybe not, we don't know that. But transition, yeah, sure. So that's how you look at it.
Okay. So thanks a lot, Devashish, for giving your time. I personally felt this was like half a degree for me at least. And I hope our listeners are also going to be really appreciative of what you've done and given your time to us.
Sure.
So thank you so much for doing this, Devashish.
Yeah, well. Uh, have a
Okay, bye-bye.
We hope you enjoyed this absolutely brilliant conversation as much as we did recording it. Mutual fund investments are subject to market risks. Please read all the scheme related documents carefully before making investment decisions. This podcast is for informational purposes only and should not be construed as a basis for investment. The views and opinions expressed by the guest and the host are solely their own and do not reflect the views and opinions of the organizations that they work for. Please consult your financial advisor before making any investment decisions.